The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back to Volatility Views, your weekly source for all things volatility. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. And I'm joined today on the old Volatility Views panel, first off by my boon companion, the yin to my yang, good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the program.
Thanks very much, Mark. It's a pleasure to be here, and I had fun filling in last week as you were down at the Options Industry Council, but I don't want to make a steady diet of it, so I'm glad you're back at the helm.
Sure, I was off at the conference, and you guys had a great old time with Richard Sandor on the show. That was a great episode. I encourage all of our listeners to download and take a listen to that one, because that was a fantastic chat you guys had with Richard, the father of financial futures in many ways, shapes, and forms. And of course, I'm also joined on the panel this week via the magic of cell phone by good old Mark Sebastian from OptionPit.com. Mark, thank you for joining us today, and hopefully you won't swerve off the road in the middle of our conversation.
I'm gonna do my best. It's a beautiful day here in Michiana. I am on my way up to beautiful Detroit. Going to do some research on autos for a couple of days, so I can figure out what my next major investment decision will be. And by that, I mean I'm taking my kid to a day out with Thomas.
There you go. Well, we're just joking, of course, listeners. Mark is not actually driving, so he's free to chat with us on his trip up to lovely Detroit. But with the team assembled, we're going to dive right into our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we look back on the week's worth of volatility action and what's been going on in the land of VIX and NASDAQ, as well as other vol products that may catch our eye from time to time. And let's start off in the land of VIX, as we are wont to do. Mr. Sebastian, what have you been watching out in the old S&P 500 volatility landscape over the past week?
I was 100% certain we were going to break on Tuesday. Was it Tuesday when we were really, no, it was Wednesday. I'm sorry. Wednesday morning, I was 100% certain that we were really, really going to break. We saw the VIX heading toward 22%. The market was down huge. And 3 days in a row, we had this weird kind of, I call it a cross between cliffhanger and Groundhog Day. It was like the market was Stallone at the opening of Cliffhanger, Stallone hanging on that girl, her gloves starting to slip, and just as she's starting to slip, he wakes up and realizes he's hanging down to that girl again. And it just turned out that, we're going to need more than it could be bad in Europe to break the market below 1350. The U.S. markets are willing to accept things are kind of cruddy. They're just we're going to need things that are really, really bad if we're going to break here, because the market, super resilient, keeps bouncing. The VIX held 20. The VIX did not manage to close above recent highs. Just nuts. I thought we were cooked, and now I think we might bounce right back up to 1400. Because it looks like they're going to run re-elections in Greece. There's no way that those crazies are going to get reelected again. And who knows? But I've never seen anything like it. I thought we were toast. And, VIX managed to bounce off those lows. Even in the face of JPMorgan this morning, VIX couldn't even break 20. Just goes to show you where the market is understands the risk and appears to be hedged. That's kind of the story.
And that's what you get for underestimating good old Sly Stallone, sir.
That is what I get for never underestimate Stallone. I just worry that one of those days that glove is actually going to slip, and that girl's going to fall to her doom.
It's coming. It's lurking in the future. But of course, you're right. There is this extra note of tension and fear in the markets today because everyone is wondering what the next shoe is going to drop post JPMorgan if other firms have similar risk on their books yet again. And you're right, the VIX is barely up 2% today, so it hasn't really even popped that much to the upside. So yeah, I guess people, you're right, are digesting this news with perhaps a little bit more decorum than you might expect. Of course, it's not like we haven't been down this road before.
I know.
So one or two more banks having nasty, ridiculous, poor risk management is not exactly news in this day and age.
And that's the whole thing is that I think that it's the enemy we know now instead of the enemy we don't know. And I think that puts things in a lot different perspective. And for Europe to finally step up the rhetoric and just say, you're done, Greece, if you don't do this, I think is probably a good thing for the euro. I think it'd be really good for the euro for them to just say, we're holding back all the money, goodbye Greece, and because all that debt's been written off anyway, and then be able to concentrate on making sure Spain and Italy is okay. All of those dollars that don't get given to Greece fattens the war chest against some of these other pig countries.
Yes, exactly. So a lot of interesting things to keep an eye on for the future. All right, thank you for that, Mark. And now turning our eye squarely to the land of NASDAQ vol. We've been talking a lot about the seesaw, the roller coaster that is Apple Plus, a.k.a. NASDAQ and NASDAQ volatility. And this past week, actually, comparatively, wasn't too much of a roller coaster. We saw several days now where Apple was almost unched, and that is a relatively rare occurrence in this day and age. And we know when Apple is relatively unched, that NASDAQ isn't moving a whole heck of a lot either. So, Don, what were your big takeaways from the past week's worth of volatility action over in the NASDAQ?
Well, actually, for the second or third week in a row, despite any individual stock performance, the 1 month and 3 month realized volatility of NASDAQ did in fact go up very slightly, just a couple of percentage points. And I think if there's anything rarer than my predicting rising volatility for about 3 or 4 weeks in a row now, is that it actually did come to pass and I got it right. But again, ever so slightly so. 1 month was 1786 last week when we discussed this. It's now 1806, so a very slight increase. 3 month was 1394, up about 4% to about 14.5. What's interesting about this, and we touched on it last week as well, is that we have to keep that clear distinction between VIX and implied volatility and actual market volatility. So here we've had this phenomenon during the week with a slight rise in actual index or asset volatility, even as VIX might have dropped somewhat. So you have simply a contraction in the spread between the two, with the risk premium of implied usually being a little bit higher than the actual volatility. So it's not impossible for Mark to make a prediction that implieds might even go a point or two lower during the upcoming week, while I might predict that we actually could go higher in terms of the realized volatility. That's actually something that may have been taking place for the last couple of weeks. And when we look at the crystal ball in a little while, maybe I'll have a little more to say about that.
Yes, there certainly is a lot of room these days, or perhaps a little bit less room, but still a lot of room to work with and to play with between that implied vol premium and the actual realized vol. There certainly is a lot of room for those two to catch up with each other. So interesting to see the dynamics going on as they two play off each other going forward. Well, thank you for that, Don. And now we're going to close out our volatility review segment and dive right into a very interesting volatility viewpoint with a very special guest.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint segment. This is, of course, the portion of the show where Don, Mark, and myself welcome on some esteemed guest from the world of volatility and volatility trading. And today's guest is Todd Petzel. He is the Chief Investment Officer over there at Offit Capital. He is also on the board of directors of the National Futures Association, and he is also the author of Financial Futures and Options, a guide to markets, applications, and strategies. Todd, welcome to the program.
Thank you. It's great to be here.
Now, Todd, I just gave our listeners a quick synopsis of your background there, but as we are wont to do here on the program for first-time guests, why don't you give our listeners a bit of an overview of your background in the derivative space and how you found your way to being the CIO over there at Offit Capital?
Well, it wasn't a straight line. I started out as an economist trained at the University of Chicago through a PhD and thought I was going to be a college professor all my life, but that didn't last long.
Don't worry, we won't hold that against you.
Most of my research was on physical commodity markets. And in the early 80s, I moved over to the Coffee Sugar Cocoa Exchange. And after the crash of 87, I became the chief economist at the Chicago Merc. So I developed a lot of new products, spent a lot of time obviously thinking about options and futures and volatility. In the mid-90s, I kind of shifted gears a little bit and was asked to become the chief investment officer at a not-for-profit organization called Common Fund, which invests money for colleges, universities, foundations. And when I left there, we had about 1,600 not-for-profit clients investing over $30 billion. So Offit Capital is a wealth advisory firm. We're much smaller than Common Fund. We have 70 advisory relationships, and we advise on about $6 billion. But we do everything from cash to long bonds, long stocks, and every alternative class. So we build customized portfolios. And frankly, the reason I'm happy to be here today is that our clients are very concerned about volatility. You can't get through the last 5 years without thinking about volatility and the various options to try to address it.
Well, that is our bread and butter here on the old Volatility Views program. And since you mentioned talking about some of the different options, pun intended, for addressing that portfolio vol risk, that portfolio risk in general. We've had a lot of people on the show over the past year or so who've espoused a lot of different tools for doing that. Some people like to go with the direct downside S&P approach. Some people like to go more of the, let's say, intangible upside of, let's say, a VIX call or some of these VIX ETP. Some people lean towards the OTC vol and variance swaps. When you're customizing these portfolios for your clients, what's your poison of choice these days when you're talking about getting at that portfolio volatility risk?
Well, the first choice, of course, is to try to get the basic asset allocation right and matched up with the tastes and desires of the client. But if we have to fine-tune it along the edges, you won't be surprised to hear that, given my exchange background, that we are not big fans at all of structured products or ETPs or anything else that is out there that is seemingly being very aggressively sold to investors as solutions. Because typically, in my experience, they've been much better solutions for the people building them than the people buying them.
Yes, we've certainly talked a lot on this show about the universe and the ever-expanding universe, I suppose you could say, of structured VIX products and ETPs and other volatility products that are exploding out there. And that universe really has just become an interesting area in and of itself, and some of the push and pull those products are having on the underlyings they're supposed to be derived from. And I take it from your comments that you're obviously not a big fan of many of these structured VIX products in particular? Do you think they're designed poorly, or perhaps maybe they're having a detrimental feedback effect on the VIX and vol itself, or maybe all of the above? What is your primary concern with these products?
It is absolutely all of the above. These are structured in a very opaque way. The people who buy them don't really understand all the embedded costs and the, what I'll say is the headwind of being a successful investor and using them. And unfortunately, I think enough money has rolled into them that it's really distorted a lot of the markets. You guys have talked about the forward vol curve being very steep in the past. I think that is a direct artifact of people who are running out and trying to buy tail risk without really understanding all of the implications. It's a crowded trade.
Yeah, well, here's a kind of a thought I have, and let me know what you think. I would liken the volatility ETPs to a lot of what went on with the mutual fund industry about, 20 years ago. Let's not forget that 20, 25 years ago, you could sell a private investor a load mutual fund, and the industry eventually evolved. And, load mutual funds are basically out of business. You've got ETFs that are really doing a much better job than the mutual fund industry. And I think that you're going to see the volatility ETPs kind of go the same direction. We've already seen the second generation of ETPs get much better. I would say that, an ETP like XDD does a pretty decent job, whereas a VXX or a VXD does a terrible job. What would be your comments to kind of that thought process?
Yeah, Mark, I think that's a good analogy, but I think there's one huge difference, which is in those load mutual funds in the early days, you could actually clearly educate an unsophisticated trader as to why it was a really bad idea. Paying 4% or more up front just doesn't make a whole lot of sense. The problems with these newer generation of products are a lot more subtle, and I think you have to be a lot more sophisticated to appreciate where the headwinds are coming from. But I completely agree with you that the market should take care of this over time. It's just unfortunate that people are having to pay so much tuition to get their education.
No, I would agree with you 100% on that, but I would put fault as much on the individual investors as I would on the people that built the product, in that if you went through and you looked at 2.5 years ago, 3 years ago, if you went through and looked at VXX and read the prospectus and took the time to research the product, you knew exactly what was going to happen. There are people that literally have been short some of these ETPs from day one and wrote them down for about $200 before everyone figured out that you shouldn't be long these, and they went really hard to borrow. So I agree with you that a lot of blame needs to be shifted onto that. A lot of blame belongs to Barclays and Credit Suisse and all these firms, but I'm not the type of guy that's going to give the individual investor a free pass. If you're trading in something that you don't know what you're doing, you deserve just about everything you get, in my opinion.
No, I don't disagree. And obviously, since I get paid for giving advice, and I read those prospectuses and knew what to avoid, I'd like to think my customers are getting their money's worth. So I honestly believe it's a two-way street. But I also honestly believe that most of the structured products out there are not bought; they're actually sold, and they're sold pretty hard. So the incentives are there to build these products and to peddle them, and they're getting peddled.
Couldn't agree more. I do agree with that. But the good news is that somebody's gonna figure out how to do this right, and it'll get rid of everything else. Kind of like what happened with spiders. You don't see a lot of people trading the Fortune 500 ETF, the triple F, if you will.
Right.
So, Todd, tell me now, without divulging too much of a proprietary nature, the actual types of activities and perhaps the products you do use, whether it would be options or simply the asset allocation that you mentioned, looking for non-correlated assets or even negatively correlated to dampen volatility. But if volatility of the portfolio and ultimately Sharpe ratio is a concern of yours and your clients, what types of strategies and instruments are you using currently to try to address the volatility risk and mitigate it somewhat?
Sure, Don. I mean, that's a great question, but let me characterize my client base a little bit. I'd say about 3/4 of our clients are multi-generational high-wealth families. I suspect if you gave them a test on how to spell the Sharpe ratio, they might not get it right. So they're very hardworking and nice people, but they don't care about maximizing Sharpe ratios. What they care about is real permanent loss of capital. And so we're actually spending a lot of time trying to talk with them about the difference between short-term volatility and long-term risk, and address that through the portfolio construction process. We have used direct stock index options in the past for a very straightforward, insurance approach. If people get a little bit over allocated to an area and they get concerned and they're willing to pay the insurance cost. But we are actually pretty big believers that relying on past correlations is a path that could get you into trouble. I guess we could ask our friends at JPMorgan these days about that particular theme.
Yeah, no kidding. No kidding.
So we've always said, look, if you really want to remove downside risk, you've got to step up to the plate. Open your wallet, open your eyes, and pay your insurance premium, and hopefully, get the benefits. And we've done this in equity indexes. We've done it a little bit more in currencies, in fact, where our clients have had exposures to other jurisdictions, other currencies. But we're pretty old-fashioned in our approach. We'd like to know what we're paying for and what we can count on getting when and if the options go in the money.
Here's a question for you involving, if you're dealing with people that are really concerned about loss of capital, which means you're dealing with kind of certainly the 1%, let's just say, how do you protect them against inflation risk and kind of loss of capital without really losing capital? I'd imagine that your client base, to bring up currency risk, things like that, that's got to be a major concern for them. I assume that's something that you approach in your portfolio management for your clients.
Yeah, it's absolutely a focus, and your point about the inflation risk is absolutely the world we're living in spades. In the old days, if you got nervous about temporary volatility, you went to the sidelines and you earned 3.5% or 4% in your muni portfolio, and you felt pretty good about that. Today, you go to the sidelines and you go to treasuries or your short duration, high quality muni portfolio, and you're earning negative real rates of return. And that's just like a bleeding of the patient in a very slow fashion. There's nothing dramatic about it, but it is a permanent loss of capital. Our clients get that. They would love to go back 10 or 15 years to the good old days where they could go on the sidelines and still make a little bit, but they know that's not the world today. And so they are willing to do things like look at higher yielding bonds, going out on the risk curve that way, with the understanding that if the manager does careful credit work, there may be month-to-month volatility like we saw in the second half of last year, but there's a pretty good chance that those bonds are going to get paid back, and you might actually stay ahead of the game versus inflation. So that's back to my theme of what is risk, and mitigating volatility for just dampening the report card, so to speak, is not really the smartest thing to do if you want to reach your long-term goals.
Todd, I have a question here for you that's a little bit afield from the vol topic, but I'd be remiss if I didn't put it to you because you are somewhat uniquely suited to discuss this topic. I was on a panel last week down at the Options Industry Conference, and the topic of that panel was financial advisors and asset managers and their use of options, or more appropriately, the lack thereof. And there was a lot of discussion on that panel and throughout the whole conference about there's an entire universe out there of asset managers and advisors who are managing hundreds of billions, if not trillions of dollars of primarily long-only funds that, for the most part, on paper, are ideally suited to very basic options overlays like protective puts and covered calls for income, and yet they aren't touching them in any appreciable degree. Now, you're in a relatively unique position since you've come up through the derivatives world, and also you are an active financial advisor and run one of the the few firms that actually implements derivatives in your asset management. So I'm curious what your opinion is on that problem and why you feel more advisors and more asset managers are not doing exactly what you do over there at Offit and incorporate derivatives as protective instruments and actually also start to take advantage of some of these volatility tools. Is it just lack of education? Are they intimidated by the product? Do the firms they work with, primarily the brokerage firms, do they not facilitate it? Is it a lack of tools? Is it all of the above? Is it something else entirely? Why do you feel that so few firms are out there doing what you guys are doing?
Well, I'll tell you, when I was at the exchanges, I asked that question to the community almost every day of my life. And now that I'm in the community, I'm kind of glad that I don't have as much competition as I might. That's a flip response, and I apologize for that. But the reality is it really helped to come up through the exchanges to understand and not be intimidated by these products. Most people don't have that benefit. They think of even options, even long only options where the premium is the only at risk. They think of that as being a risky activity, and it takes an awful lot to get them up the learning curve to explain how you're not trading these things on a one-off basis, but they're part of an integrated approach. It's part of the portfolio. It complements it. It shapes the profile. I'll give you an example right now of one of our success stories is that we have a family who came up multi-generations with a large amount of company stock. They have reached a point in their life where they want to diversify their portfolio. They want to move that stock out, and it's a big chunk of dough. How do we do it in a thoughtful way? Well, some families would say, well, I'll just start putting in limit orders to sell the stock when I think it's appropriate. What we're actually doing with this family is, given the nice, good volatility in the marketplace, we have a program of covered calls where the stock is being drawn away with probably a 2 or 3% premium over what they would earn if they just trickled out the stock with sell orders. This is not a risk management tool. This is a value added tool to the process. We've also had families who've sold below the money puts when they wanted to build a position, but only at a certain low price. And that is a tremendous opportunity these days, given what people are paying for put protection. So that's a very long answer to a simple question. I don't know exactly why more people don't do it. It really drives me crazy when I talk to outside long-only stock managers, when I ask them, how do you use options to complement your strategy? And they look at me and say, oh, gosh, no, we just don't do that stuff. Well, if they don't know how to do it, I'm kind of glad that they aren't. But I just keep searching for the guys who are really quite thoughtful and proficient in their approaches.
Yeah, you're certainly unique in that respect then, or relatively unique amongst the world of asset managers, in that you're actually incorporating these tools to any appreciable degree. And obviously the current level of what we're using to certify and teach these advisors and asset managers is obviously insufficient to get them over to the dark side, so to speak, and start using some of these products. So do you think, one of the things we were banding about last week, I'd like to get your opinion as well, do you think maybe there is an opportunity to have the industry rally together and really create a separate options certification exam that these planners can take, become certified in options, and then they have a shingle that they can hang on their wall and market themselves as a way to differentiate themselves from the advisor X down the street?
I think that's actually a great idea, and I would presume that somebody like SIBO would be in the forefront of wanting to sponsor it. I mean, just to help move the education ball forward.
You might think
Mark,
that, but
are you implying that the SIBO wants to sponsor shingles? That seems a little odd. I thought people were trying to get rid of that.
Todd, I have a question for you. We kind of joked about clients who probably couldn't even spell Sharpe ratio, but surely you're very aware of its significance. And what I would ask you is, if the clients aren't doing it, how do you evaluate your effectiveness, and how do you evaluate your performance internally in terms of the kinds of returns that you get for the clients, but knowing that you do, in fact, want to control the overall volatility of the portfolio. It doesn't get discussed a whole lot. It kind of irks me a little bit, and I wish it were discussed more and reported more in mutual funds and in the literature or what have you. But if you manage through your skill to get, great returns for your clients, and somebody else manages through his skill to get similar returns for his clients, then ultimately, at least to some people, the person who did that or got those returns with the lower amount of volatility is in some ways doing a more effective job. So where does that enter into your consideration, even as, you may get returns for people, but there can be upside volatility as well as downside?
Sure. Don, if you'd looked at one of our client reports, you would actually see that on the first page, our summary page, where we hope we give the entire picture, we talk not only about the returns and the composition, but also the volatility of those returns over a long period of time versus the benchmarks. The challenge there, though, is that, as you appreciate, not all investment options are created equal. And I'll pick on one of the ones that's getting in some, I think, appropriate press finally, which are non-marketed REITs. They have been around for a long time. They are not marked to the market properly, in my opinion. They are oftentimes sold to less suspecting people because of their low volatility versus their returns. And in fact, all we're doing is just not observing the volatility in an accurate way. So when they go toe-to-toe with exchange-traded, publicly traded REITs, they look like the superior vehicle. But in fact, there may be a lot of stuff going on underneath the covers that you can't see that are not good things. So your main point is really well taken, but you got to make sure that every investment that you're looking at is done on an apples to apples basis. I'll tell a story on some of my old colleagues. In the past, I had a real estate group who used to come down to my office and tell me that we had to get a lot more real estate into client portfolios because it would lower the vol of the overall portfolio. And I would look at them and say, guys, just because you don't measure the volatility doesn't mean you don't have risk. And I reminded them of the Chicago Mercantile Exchange building going from $20 million to $80 million back to $30 million from 1985 to 1990. It wasn't marked every day. Nobody saw it in a real life fashion, but there sure was a lot of vol. So you guys all appreciate the fact that measurement is one thing, and then having meaning behind that measurement is a bigger issue that needs to be really well understood.
So maybe along with that option certification exam, we need some sort of certified vol measure that we can apply to all of the various advisors and asset managers out there, so everyone can have a clear benchmark of how this person is really doing on a true volatility and risk-adjusted basis, and not just comparing these raw returns that we see bandied about all the time. Yeah,
I mean, it'd almost be cool to put option-related asset managers up against like the SIBO myriad index or something like that as a potential benchmark. Something like that would be interesting, don't you think?
Well, I think it's a great idea, and on a kind of a related topic, I just saw a paper this week from the Kauffman Institute, the Kauffman Foundation, where they did a 20-year analysis of their venture capital portfolio. It was a wonderful paper, and one of the things that they tried to do was to put those returns into a public market equivalent basis. And it was really an effort to get to apples instead of the typical vintage year IRR comparisons that are all over the place. And it really was a major step forward, in my opinion, in getting that risk footing on a comparable basis. And I think all of this is really quite important.
Now, Todd, you mentioned earlier the recent debacle over there at JPMorgan. Certainly going to be in the headlines for quite a while. It's like yet another quote-unquote rogue trader out there slinging CDSs and potentially blowing out a firm. Now, you've been pretty active. You're on the board of NFA, you're on the board of FIA, and you've been pretty active in that environment, particularly around position limits. I know you testified before the CFTC in the past about that exact subject of position limits, particularly in derivatives and futures and margin on those. Now, I'm curious, given your involvement with all these various boards and the various activities you have on that front, are you concerned that a lot of the pending regulations we're going to see coming in to limit position size and margin on a lot of these products is going to be shaped by a, shall we call it, a knee-jerk populist reaction to nonsense like this JPMorgan thing, rather than listening to the sound advice given to them by people who have actual economic policies in mind, like yourself when you testified before the CFTC? I'd imagine we'll get a lot more of the former than the latter.
Yeah, absolutely right. I mean, I had the good luck in my first exchange job in New York to not only run research but also be in charge of market surveillance. So I got to watch when Hershey's was buying cocoa and when M&M's was selling cocoa, sort of thing. It was a phenomenal education, but more importantly, it really did reinforce my notion that position limits for the sake of position limits just don't do a thing. And it's much better to have a liquid market where an awful lot of people are allowed to participate in meaningful ways than to try to have kind of some knee-jerk, as you use the word, reaction and limit in place, which would ultimately push people to find solutions someplace in a less regulated environment. I'm obviously a huge fan of exchange-traded, exchange-cleared products because I think the controls and the systems have proven themselves over a long, long period of time. And it's somewhat ironic to me that the best intended regulations oftentimes push people away from these good markets and into the hands of places that are somewhat less controlled.
Yes, this capital is liquid and can go anywhere, and there's this mistaken assumption that they have to do all of their business within the confines of the U.S. And there's a lot of places this capital can go, and a lot of marketplaces that they can go to do a lot of dubious things. That if we just push them outside of it, that's exactly what they will do.
Absolutely.
Well, Todd, I think that's about all we have for you today, unless there's something else that you'd like to add.
No, this has been great fun, and I enjoyed the questions, and I appreciate the opportunity to join you.
Well, we were very glad Oh, good.
Yeah, we enjoyed asking away, and you're a real sport. We definitely handled the hard ones, which is real impressive, Todd. I really enjoyed talking to you.
Anytime I can help, I'd be happy to.
Well, thanks again for coming on. We'll have to bring you on again down the road. Maybe we can look back at some of these other developments we've been talking about in the marketplace and maybe drill down to them in a little bit more detail.
Very good. Thanks, Mark. Thanks, Mark.
Thank you, Todd. Pleasure to speak with you.
Thanks. Bye-bye.
All right, and that's going to do it for the Volatility Viewpoint segment. And now we're going to dive right into our Crystal Ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball. This is, of course, the portion of the show where we prognosticate wildly about the future and attempt to divine what the volatility gods have in store for us. And first up on the old Crystal Ball platform is good old Mark Sebastian from OptionPit.com. And Mr. Sebastian, given what we chatted about in our volatility review, I have a feeling I think I know what you're going to say, but why don't you dive into it anyway regarding your outlook for the future here of S&P 500 volatility?
I have no clue. I'll be honest. The market keeps acting counter of what I would expect. I would have thought on a day like today, we go up to 22%. I would have thought that, a horrendous elections in Europe would head us toward, 25%. The market just keeps bouncing off 21%. Looks like we're going to make a trip to 17 before we make another trip back up to 21%. That's just the way it is. Bonds are completely overdone. So those, if I was going to do anything this week, I think believe it or not, the safest trade may actually be shorting U.S. Treasuries, which it sounds counterintuitive.
Well, listeners, you know Mark Sebastian, having listened to the show for a while, he's certainly not shy of sharing an opinion. So when even he is reticent to share an opinion, then perhaps it's time to keep your powder dry.
I think this is an excellent opportunity. If you want to do anything, sell some longer-term premium that's on the curve that has a little more juice to it. But I would be very reticent and very hesitant to be selling any near-term premium just because I think there's such near-term ability for the market to do anything. Who knows?
Yeah, it's a lot of gamma risk to put on your plate along with the vol that you probably don't want to bite off in this environment.
I'll accept vol risk. I will not accept gamma risk right now. That's basically what it comes down to. I don't mind implied vol risk. I just don't want realized vol risk, is the way I would put it.
All right, and thank you for that, Mark. And now, as we are wont to do here on the old show, it's time to turn our attention yet again to the world of NASDAQ and NASDAQ volatility. And Don, in the volatility review, you and I were chatting about the risk premium or the implied risk premium and how that's starting to come a wee bit closer to the realized vol level. So I'd imagine going forward, you're predicting a continued contraction between the two.
Yeah, it's hard to say exactly where implieds go, and you know that over the course of the past year on the show, I haven't speculated too much about how they're going to guess where the next guess is going to be. It's just not my cup of tea. But insofar as realized, as you look at the graphs and the trend lines, you do see both 1 month and 3 month gently sloping upwards without the sign yet that we might have that downturn. And at the risk of really going out on a limb for probably what now might be the 4th week in a row, I'm going to say that although it won't be dramatic, we may indeed still have slightly rising numbers insofar as actual or NASDAQ realized volatility is concerned. The reason that I say I don't think there'll be anything dramatic is the other part that's been interesting, and of course, it can always turn at any given moment, especially with the kind of news we had today with JPMorgan, is that volatility of volatility, just simply how quickly volatility itself is moving, has been lower than average across all measurements. 1 month NASDAQ vol is 71 when the average is 85. 3 month is 33 when the average is 36. And quite extraordinarily, going back an entire year's worth, where average yearly NASDAQ volatility has been about 9 3/4 over the long haul, it's been 3.5 for this past year. So they say that we live in volatile times, but at the moment, the movement of volatility itself has been anything but particularly volatile. So I go on a limb saying that volatility will go higher, but at the same time, I'd say that it might do so without anything terribly dramatic. So we're not looking for big movement. We're really just looking for a continuation of this upward slope. And this is, I'm just looking at it now. I hadn't consulted this when I made my previous remarks, but we always like to look over at the Volatility Institute and the work that Robert Engel is doing with his VLab and predictions for forward-looking 1 month realized volatility. He's got it about 18 3/4, which, if correct, would kind of confirm this a little higher from here, but not a lot so. And then about 20.5 for future 3 month volatility. So we'll keep a look at and check these each week and see how we're doing.
All right. Thank you for that, Don. All right. And that's going to do it for this episode of Volatility Views. We, of course, want to thank our guest, Todd Petzel from Offit Capital, for joining us today and having a very interesting conversation, and an interesting and wide-ranging conversation on a variety of interesting topics that affect us here in the options and derivatives markets. And, of course, I also want to thank you, Don, for joining me on the program today. And before we go, what is going on over at volex.us that might capture the attention of our listening audience?
Just a reminder, of the link that we put up. You mentioned our show last week with Richard Sandor, who was a fascinating guest, and I am assuming that a lot of our listeners would like to know a little bit more about him and some of his recent adventures. So we've put a link to his tremendous opus magnum that he has just completed, Good Derivatives, a story of financial and environmental innovation. Take a look at that. The link also has a quick interview with him. For those of you who don't know what Richard looks like, you can actually see him on a 2-minute clip, and I think that it behooves everyone who's interested in not only the history of financial futures, but some of the recent environmental work that he's done to take a look at this wonderful book.
Yeah, in this environment, and given the news we just saw this morning about JPMorgan, I think a book called Good Derivatives and laying out some of the positive aspects of these products is perhaps more in need than ever before. It certainly is alone on the bookshelves. There aren't too many tomes in praise of derivatives out there. There's more than enough describing them as tools of scandal and destruction, but not too many weighing down the other side of the old seesaw.
Yep, that's true. And when I used to do our options seminars back in the day, when you had Orange County and Gibson greeting card and Metallgesellschaft, I guess derivatives have been blamed for all the ills of the world for the last 20 years or so. I used to start with a little cartoon as my first slide, just to kind of loosen up the audience, and it showed a guy panhandling, holding out a cup, and such people always have a sign next to him, and this one said, "Dabbled in derivatives." I never forgot that.
That's a good one. Maybe we should copy that over here and put it in the show notes so our listeners can have a good chuckle at that as well. And speaking of good chuckles, what is coming up over in the land of optionpit.com that may interest and or intrigue or perhaps just amuse our listening audience?
Wednesday this week, I'm doing the second in my series of free webinars on the weekly options. I'm discussing short ways to be short premium in the weekly options, and then next month we'll do long premium. So this free webinar on short premium weekly option plays, you can go to optionpit.com/events to register.
All right, thank you for that, Mark. And that is going to do it for this episode of Volatility Views. We, of course, want to remind everyone out there that if you want to hear any back episodes of this program or learn more about any of the topics we discussed on this show today or any of our guests, or indeed listen to any of the other shows we have here on the Options Insider Radio Network, then by all means surf on over to www.theoptionsinsider.com. You can find all of that content there. You can also search for the programs in iTunes and on Stitcher and in the Zune Marketplace and just about anywhere else fine podcasts are purveyed. And that is going to do it for this show, but of course we can't leave without thanking all of you out there for downloading and streaming and subscribing to the program and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.